Okay, it's 11 o'clock. We'll get going because there's a lot to cover this morning. So I'm going to be talking through the news. Then Andrew's obviously going to be covering what's happened in August. And then I'll be talking to our guest this week, who's Randall Sandstrom from Sequoia Economic Infrastructure Income. That's a late change to last week's lineup, but we're quite pleased that they are doing it because we've been quite keen to talk to them for a while. So news first. As you can see, this is a long list, so I'm going to rattle through them if you don't mind. There's a lot of property on here. Richard's on holiday, so it falls to me to cover this stuff. But here we go. PRS REIT first. Obviously went to a big discount, still about 25%, even after this share price rise here. And that share price rise is related to what we're talking about this morning. So obviously last week, this was covered off on the show. But to recap, there's been a requisition for a meeting to replace the chairman and one of the directors with Robert Naylor and Chris Mills, who you remember were parachuting to other funds before and have done a good job of sorting them out. That resolution is getting more backing, and I think it probably will be carried. As a sort of recap on PRS REIT, so launched in 2017, it's homes for rent, private rental sector stuff. That's what PRS stands for. And it raised quite a lot of money. It's taken quite a while, obviously, to build these houses. And we're almost through the process of doing that. And one of the things that Richard is concerned about is that obviously what happens next. Ideally, it would sell these houses, recycle them, build more, because obviously that's what the economy needs. But we'll have to wait and see if that's possible or whether shareholders actually want their money back. So investors have come quite frustrated about the discount, which is understandable. But I think what really tipped them over the edge was this idea that they were going to extend the management contract by 2.5 years out to 2029. So it's already quite a long notice period, but they're talking about making it 5 years. And that is extremely unusual. It just creates a poison pill, really. They were trying to sort of sugar the pill by saying there would be a lower base fee. But I don't think that's good enough, really, when you can think about all the options that might be needed to narrow the discount down. So the board set up a subcommittee to deal with this requisition. One of the, again, controversial things that they've done is they've appointed another advisor, Rothschild. They're already paying Singers and Jefferies to act as advisors to the company. Everybody that we've talked to says we don't understand why they need a third one. Obviously, these things aren't cheap. But they are thinking about what might happen. So they're thinking what they can do to try and talk investors around. So it's looking more likely that there will be some asset sales in 2025. And that will be used to fund share buybacks, even if this doesn't go through. But I think, as I say, that this requisition is probably going to succeed. The requisitionists and the shareholders that have signed up to it and said they're going to support it are annoyed. They're very annoyed about the management contract. They say the board has been really bad at talking to them. And they're worried about whether the board's in the manager's pocket. And AVI stressed this point about Rothschild, which, as they say, advised the manager on its sale, and therefore they wonder whether it's really representing the manager but being paid for by the company, which is obviously not great. So we'll see what happens with that one. This is a bit more clear cut. So SEGRO are bidding for Tritax EuroBox, and again you can see the discount narrowing on the back of the news that they were looking to do something. And that's finally come to fruition. So it's an all-share offer. There's no cash option, which is interesting. It values the EuroBox shares at 68.4p. That's a decent premium to the share price, and obviously that means that investors are probably thinking, well, that's it then. But it's quite a big discount still to the NAV, and there were lots of other parties interested. So I'm not saying this is another hypnosis type situation, but it may not necessarily be a done deal. We'll have to wait and see. EuroBox, you should know from our notes, it's logistics, single let warehouses in Europe. Decent sized portfolio, obviously partly debt funded. Spread of countries. All of these things were hit quite badly when interest rates started to go up. That meant that these things traded on high yields, and that drove down valuations, and that affected gearing ratios and all sorts of stuff. Discounts widened as well because obviously the yields that these funds were offering weren't as competitive relative to cash and bonds and things. So it's no surprising then that the board felt something that needed to be done. And then in June, they said that we're talking to Brookfield, and Brookfield were thinking about making an offer. And it's the fact that Brookfield were involved that's making me wonder whether there might be a counterbid, but we'll see. Obviously, if you're a EuroBox shareholder, it's not a bad deal. You're getting a decent size uplift. You should get some decent returns from SEGRO. It's got a very good track record. It does come with a lower yield. That's the hit that you've got to take for doing this. SEGRO's got a development program, which means that there could be sort of NAV appreciation coming from that. And obviously, it's a far more liquid investment. I think that's why they're not offering a cash exit, because I think they're reasoning that people who do want cash can just sell SEGRO shares in the market once it all goes through. For SEGRO's own shareholders, it's quite a good fit. And obviously, because they're buying it cheap, it enhances the NAV. And EuroBox comes with some very cheap debt, which is going to be quite useful for SEGRO too. So yeah, I think it's actually not a bad option, but as I say, maybe not the end of the story. We'll see. Balance Commercial Property Trust, we have another bid, very similar chart again, same sort of thing. And this time it's Starwood, so this is going to go completely private. 96p a share, which again is a decent premium to the share price. It's still a 8.7 discount to NAV, but here I think there's less wiggle room for somebody to come in and improve on this. There are perhaps other parties that might be a good fit with it, but nevertheless, I think this is probably quite a good option. This has been going on since April. It was a surprise to us when the board decided to launch a strategic review. It's problematic that restricted sectors we'll come on to in a second, but it did face a quite big discount, and the board was keen to do something about it. It's been trying to sell down its office exposure, which is one of the things that it thought maybe was causing the discount in the first place. There have been quite a lot of interest, as you can see there, 12 indicative proposals, but they reckon Starwood's is the best one. So there we go. And this just last slide that Richard put together, you can see how quickly and how far the sector is shrinking. There really isn't much left now. I know people have been writing about AEW as an attractive option at the moment. Whether we see bids for the rest of the other three, I don't know, but I wouldn't rule it out completely. Now, Artemis Alpha and Aurora are getting together. This is the next story on here. Artemis Alpha has been very disappointed for a while. This is its performance from its fact sheet, and you can see there it's a long way behind over 10 years. It's quite a way. It's sort of okay over 5, long way behind over 3. Yeah, you can kind of get the message. And the winner in the sector that I've ranked these over 5-year returns is definitely Aurora, and I think that's what's attracted the board to the idea. But that's one reason why the board might be thinking about doing this is a good option. So Artemis Alpha had a tender offer planned for October anyway, and it was going to be a 25% tender offer, so it looked very likely that the fund was going to shrink by that much. So instead, they're offering this scheme where they're going to merge it with Aurora, normal kind of Section 110 thing, which we talked about before. It just involves liquidating Artemis Alpha and rolling assets into Aurora. It's just a neat way of doing it. Change of name. One of the managers goes across to Phoenix, which is Aurora's manager, and John Dodd is retiring after a long career in the city. The cash exit isn't too bad, effectively, because there's a liquidity adjustment for the unquoted portfolio. It's a 2.83 discount to formula asset value. So that was some costs as well. So maybe we'll have to wait and see what that works out as. But there is some contribution towards the cost from Phoenix for about 250 grand in the case of Artemis Alpha's fees. The whole thing, if it goes ahead, will be effective next quarter. This is the only thing that surprises me. I've noticed this before, and I was wondering what was going on, but it's almost like they've seen this coming for a long time and been aligning the portfolio. So basically, these are Aurora's biggest holdings. These, I don't know which way around it is. Yeah, I think that's right. But you can see how similar the portfolios are. We're definitely the same two big two investments. Obviously, Hargreaves Lansdown turning into cash now. So it should be quite easy to knot these two together, and there'll be very little trading to do to realign the portfolios. JPMorgan Core Real Assets, news on this is that it's failed its continuation vote. So you can see again trading at a big discount ever since rates started to rise. Currently about 19%, despite the decent yield on offer. Excuse me. And then, so this was approaching its 5th anniversary, and it had a built-in continuation vote after 5 years. The board, I think, just decided that it was, they've been trying to reposition it to make it more interesting to investors. They suggested tweaking the strategy, but there's just been too much disappointment all the way through. I think it's too small really to do this approach properly. And it took too long to get fully invested. So the returns since it launched are quite meager. And so therefore, it's not a huge surprise that shareholders have voted against continuation. So you can see the votes there. So now, with that vote out the way, the board's got 6 months to come up with proposals, which might just be a managed wind down, which could take some time, or they might find a solution. We'll just have to wait and see on that. And lastly, I think for me, Digital 9 Infrastructure, it's a tiny fund. A lot of you had it already. I understand we're not going to dwell on this too much, but today there was just this extraordinary announcement that they've cut the NAV by 40%. And the reasoning for that, I just find that really hard to believe. They're basically saying that we hadn't actually been figuring the fact that we couldn't finance the growth of the underlying portfolio companies. And so when you do factor that in, then the NAV is going to be much lower. That is the main reason why the whole thing went wrong and they managed wind down. It's because they couldn't finance Verne Global's growth. So they knew this was an issue, and how they didn't factor that into the NAV across the rest of the portfolio, I do not understand. But obviously this is a new board, and maybe there's no kitchen sinking here. And obviously maybe they're trying to shake things up so that they actually attract bids. There are some things in the pipeline, so we have to wait and see on those. The only sort of wrinkle in all this is Arqiva, which is just the transmission network for the TV network in the UK, and that is going to be more problematic, I think. But the share price has come off on the back of this. Obviously, still a big discount to that 45p, but nevertheless, down. Right, that is enough from me. Let's now hand over to Andrew.
That's lovely. Thank you very much indeed, James. I'll just switch to my screen. Yeah, there's been an awful lot going on. It's as though when September arrived, suddenly the floodgates opened and all of these deals were announced. But I'll talk about what happened during August, which was a curious month, really, because we had quite a lot of exciting market action at the very beginning of the month. In the first week, you might remember there was a quite severe market dislocation when the US Federal Reserve decided not to increase interest rates, to decrease interest rates, but the Bank of Japan did increase its interest rate. And that was quite a surprise, actually, that caused a sudden flux of international money flows and quite a lot of misalignment, which I'll talk about. But overall, actually, thereafter, the month was quite quiet, as August often is. So the rises over the month were not, on the whole, very dramatic. After those top two, the aircraft leasing companies, which are obviously very specialized, the next three are all corporate actions that James has just spoken about. I'll just add a little bit to those, actually. Really, mainly about a balanced commercial property trust, which, as James said, is now under offer at an 8.7% discount to its latest NAV. And it's quite interesting that I agree with you. I think that seems like a perfectly reasonable offer. But I do remember our complete outrage back in August 2023, when there was the offer for Civitas social housing at a significant discount to its NAV. And that's interesting because actually that was a much wider discount. It was 26.7%. But now the offers that are coming in this late cycle activity in the real estate sector are tending to be between about 5 and 10% on average, which does make that offer for Tritax EuroBox look a little bit on the cheap side. So it'll be interesting to see if Brookfield Asset Management do come in with a counter bid. I wouldn't rule that out. So there could be further developments to come there. Just working our way down the list here. It's quite interesting to see Seraphim Space on there. Clearly, this is quite often on the list of movers each month. It's a volatile stock, but it had some quite interesting news, and I enjoyed reading its monthly updates about what's happening in the space industry. And this month, it seemed to me to have a slightly different tone in that it was really about actually monetizing these investments and that there's real money flowing into this sector. So maybe that's one to have another look at. But the trusts I'll talk about today are two of these Japanese trusts that actually managed to rise over the month by about 6%. And also at the bottom there, Hansa Investment Company, which I'd just like to draw attention to really to talk mainly about the discount. So I'll come on to those, but amongst the fallers during August, again, I think these were fairly muted. We did have a number of growth capital trusts there towards the top. Schiehallion, which again is often on these lists, Hydrogen One, RTW Biotech. Again, I think this is not unexpected given that volatility we had early in the month, because there was some flight out of higher risk situations. And I think growth capital is certainly considered that way. Thereafter, I think the falls were fairly muted. Digital 9 went down a fair bit more this morning on that news, another 10% or so. Also on the list, one that's quite interesting is Geiger Counter, which is very much beholden to the global uranium price, which had been very strong indeed in the second half of last year. And it's fallen back quite a bit, the spot price. But actually, if you look at long-term uranium prices, they're actually much more stable. So my feeling is that there isn't anything too fundamentally horrible underlying this drop, although it does seem justified in the near term. Okay, I'll talk about Japan now. And this was really at the epicenter of this rather curious market episode we had towards the start of the month. This left-hand chart here is the equity market. This is the Nikkei 225 index. You can see it had this very sharp drop in early August and then a fairly quick bounce back again. Then on the right-hand side here, we've got the sterling yen exchange rate, which has been progressing upwards for quite some time as the yen's been very weak. And that's been great if you've wanted to go on holiday in Japan. I suddenly know many more people who are going off to Tokyo for a trip. But actually, it's not been helpful for sterling investors. But then there was a sudden reversal with the Bank of Japan interest rate rise. And it's this currency reversal that really caused these massive money flows. And it was very much highlighted in the media as the end of the yen carry trade, where you could borrow cheaply in yen and then reinvest that money elsewhere to get a higher return. And certainly it was quite a shock to the market, which is why we had this sudden dislocation. But the weaker yen, I think, is a mixed bag actually now, because on the one hand, it was bad news for sterling investors, because it was always undermining your sterling returns on Japanese investment trusts. And so maybe it's a good thing that period seems to have ended now. But on the other hand, the weaker yen was extremely good for Japanese exporters who were often a significant part of the underlying portfolios. So it's never a straightforward question, I think, looking at the implications of currency change. So on the one hand, it does look quite good now that you've got a tailwind from the currency rather than a headwind if you're a sterling investor, but it might undermine some of the returns from portfolio companies. And I think all of this news has been quite discombobulating for investors in Japan. They're not sure what to make of it. And that could be why we've seen a significant de-rating of Japanese investment companies. You might need good eyesight to have a look at this, but these are all of the Japanese investment trusts. I've included the smaller company investment trusts here. And the orange bar is the current discount. The further left it is, the bigger the discount. And the blue bar is the 12-month average. And you can see actually there's only one of this group that's on a narrower discount than a 12-month average now. And that's JPMorgan Japan, smaller companies. But apart from that, they've all widened out. And actually, in some cases, very substantially. I think there's some perfectly good trusts here now on quite attractive discounts. So Schroeder Japan, for example, is on about a 15.5 discount compared to its 12-month average of just over 10. I think as well, this has happened right across the board. So it doesn't matter whether it's a mainstream or a smaller company's Japanese investment trust. It doesn't matter whether it's focused on corporate change or not. So actually, some of the trusts that have been very popular because of their narrative around corporate change in Japan, they've seen their discounts widen out. So AVI Japan Opportunity here and Nippon Active Value in particular actually now available on about a 9.4 discount, I think it is. So that could be an opportunity. And that's interesting to my mind because the story about Japanese corporate activity is definitely continuing and developing. And there was a very interesting piece in the FT this week about a potential takeover in Japan. And you really don't hear about M&A in Japan. Takeovers are not really a part of the corporate culture at all. And this was a very interesting piece. I would urge you to go and read it, which was suggesting that perhaps a takeover for the 7-Eleven stores in Japan could mark day zero of a new period of corporate activity. So I think there's a strong likelihood that these narrative tailwinds for these trusts like Nippon Active Value and AVI Japan are going to continue, and you can buy in now on bigger discounts. So I think that's quite interesting, worth a look. I'll move on now to Hansa, which had about a 5% share price rise over the month. This is an interesting trust, I think, in an interesting position because it's an oddity in many respects. I mean, one element to it that's important to know is that William Salomon is a massive shareholder here, and his family interests are really dominant. And so that's highly relevant and one good reason why the trust has been on a very big discount, actually, for a long time. It's currently 41%. And one other major issue here is that there's a lot of portfolio concentration. And the trust has this very large holding in Ocean Wilsons. Now, I've met the manager, Alec Letchfield, quite a few times over the years, and he always wants to talk about his multi-asset portfolio. And nearly in every meeting, people want to lead on Ocean Wilsons and to talk about that for the majority of the time, because it's been a massive holding. At the end of August, this accounted for 29% of assets, and it's always been there. And we've been waiting for news on this for a long time because actually in July last year, Ocean Wilsons announced a strategic review, and we've been thinking that it might sell its Brazilian shipping services business. But it's taken a year actually to make that announcement, which it did finally make about a fortnight ago. So it is potentially selling that business, and that could really unlock value. And it might mean that Ocean Wilsons is either sold or you get cash back. In any event, it could mark quite a shift for the Hansa portfolio. And I think there's a chance, therefore, that people might take a fresh look at it and it could be re-rated. But I don't think it's reasonable to think that that discount of 41% is suddenly going to disappear and come into even 10, or 15, because actually many other investment trusts that have large family stakes or individual stakes always persist on wide discounts. So we've got Menharden Resource Efficiency on 38%, Caledonia Investments on 35, RIT Capital on 29. We could include Canadian General, which again is always on a discount over 30%. There's something about those trusts that the market doesn't really favour, obviously to do with voting rights and control. So I'm not sure that this discount is going to come in. And while I was thinking about that, I thought, well, I'll just have a look back through my old copies of Investment Trust newsletter to see what I'd said about the discount. And actually, just over 10 years ago, we described the discount as stubbornly wide. At the time, it was 21%. So it's doubled since that time. And I think that's just a warning, actually, about trying to play trusts on their wide discounts, because discounts can stay wide for a very long time. Here's a long-term chart of Hansa to finish on, which is a 10-year chart. And it shows you that this discount gap has just persisted throughout the years. And it has widened out. I mean, you can see on this bottom chart here, it's widened out and almost hit 50% recently and narrowed a little bit now. But I think that just serves as a warning, actually, about thinking of discounts in absolute terms. And a discount of 30%, which might appear to be a bargain to you, is not necessarily a bargain if it then widens out to 40%. And so I would just, I think, treat this episode as something of a salutary tale and perhaps a warning just about thinking about discounts without really digging into the underlying investments, which is always important. So in this case, it'll be interesting to follow what happens with Ocean Wilson's and to see whether we do get a bit of a shift in the portfolio and a shift in the perception of Hansa, but I'm not convinced that's going to go a very long way. You never know, it might get back to that stubborn discount of 20% that we saw a decade ago. Good, I'll just see if there's any questions. Nothing too specific. So I think I'll hand back to you, James.
Thank you, Andrew. I spent many years in a previous incarnation trying to persuade William to enfranchise the non-voting shares, and we didn't get anywhere with it. And that discount has been. So there we go.
Yeah.
Thank you.